How do mortgage rates work? You may be wondering how mortgage rates are decided. Obviously, you want to make sure that you get the lowest rate possible, but how are mortgage rates determined? And what can you do to make sure you have a low interest rate? Hello, this is Jennifer Sims with HOMESTAR, and in this video, we will share how mortgage rates work. There are several outside factors that affect how mortgage rates are determined, but you can only control one aspect of your mortgage rate, and that is your own personal factors. Lenders look at your qualifying factors to determine your risk level. The better your qualifying factors, the better the interest rate they'll offer. Mortgage rates begin with the current market rate, so you may wonder how the market affects interest rates. Mortgage rates are also affected by the overall economy. When the economic outlook is good, rates tend to increase, and rates fall when they're not so great. Mortgage rates are determined by many elements, including the inflation rate, the pace of job creation, and whether the economy is growing or shrinking. When the economy is doing well, borrowers can afford more. The Federal Reserve doesn't set mortgage rates, but it does affect mortgage rates indirectly. The Fed controls short-term interest rates by increasing them or decreasing them, depending on the state of the economy. When the economy is struggling, as has been the case during COVID-19, the Fed lowers rates. These are not the rates given to consumers, but the rates at which banks can borrow money to lend to consumers. When the Fed decides they need to tighten up the money supply, they raise the Fed rate. While this doesn't directly increase mortgage rates, however, banks and lenders must follow suit to keep up with their cost to borrow money from the Fed. Which personal factors affect your mortgage rate? You certainly cannot control the economic factors of mortgages, but you can most definitely control your own personal factors. Let's dive into what you can do to get the best mortgage rate. This begins with your credit score. A high credit score means you're less of a risk to lenders. A high credit score shows that you pay your bills on time and you don't overextend yourself with credit. When lenders pull your credit, they see you as a responsible borrower with a low risk of default. This leads lenders to give you a better interest rate because you are less of a risk. When you have a low credit score, lenders often change the interest rate significantly because you're a higher risk of default for the mortgage. A low credit score indicates that you may not pay your bills on time or that you have overextended yourself. The credit score you need depends on the loan program you are using. If you want a conventional loan, you'll need at least a 620 plus credit score. If you choose an FHA financing, you'll need a 580 plus credit score for most lenders. Taking steps to check and improve your credit will put you in a better position to purchase a home and get a lower interest rate. The next factor you can control is your down payment. Lenders want to know that you're invested in the home through a down payment and that you aren't borrowing 100% of the funds. The more money you have invested in the home, the less likely you're going to default. If you put down less than 20% on your home, your mortgage rate will probably increase, and you'll also need to pay private mortgage insurance or PMI. There are different types of insurances depending on your loan program. Some are cancelable and some are not, like FHA. Besides mortgage insurance, if you put down less than 20% on a home, you'll also pay a higher interest rate. You're at a higher risk of default with a lower down payment, and lenders make up for the risk by charging a higher interest rate. The next thing that will affect your interest rate is your loan-to-value ratio. Loan-to-value ratio, which is also called LTV, compares the amount of a loan that you're hoping to borrow against the appraised value of the property you want to buy. The less money you put down on the home, the higher your LTV becomes, which is a higher risk for the lender. Therefore, that's going to be a higher interest rate. If you keep mortgage insurance when times are tough, if you have your own money invested, you're more likely to do what's necessary to make good on the debt. Lenders charge higher interest rates when there is a higher risk, which means if you put more money down, you have more to lose. If you have any other questions about interest rates, please give me a call. This is Jennifer Sims, your favorite purple mortgage lender, 770 307-6283.